Many investors have set their sights on the objective of amassing a massive dividend portfolio as their ultimate financial objective. The temptation of a portfolio that generates significant passive income and spits out enormous dividends on a daily basis is undeniably attractive. Dividends provide an opportunity to earn money without actively working for it, which enables one to achieve financial independence and the possibility of subsisting on investment income. In this video, we will delve into the lessons acquired from developing a monster dividend portfolio over the years, exposing frequent mistakes made by dividend investors, and focusing on the critical aspects to consider for successful dividend investing. The first 3 simple steps. Let us explore each stage in detail. The first thing you should do is put your money into corporations that pay dividends to their shareholders. The distribution of a portion of a company's earnings in the form of periodical cash payments to the shareholders of that company is known as a dividend. Investors can kickstart the flow of revenue into their portfolio by investing in the aforementioned types of businesses. This initial dividend yield acts as a starting point and establishes a foundation for future growth. The second step is to reinvest any dividends that have been earned back into the company or into some other type of high-return investment choice. Investors typically opt to reinvest dividends in order to create extra returns on their investments, rather than treating dividends as income. Investors can take advantage of the power of compounding by reinvesting the cash flow from dividend payments. This indicates that the dividends that are reinvested have the potential to generate additional revenue, which can then be reinvested again, leading to the growth equivalent of a snowball effect. At this point, the focus moves to companies that not only pay dividends on a consistent basis, but also raise those payments over time at a rate that is higher than the rate of inflation. This is the third stage of the investment cycle. Investors can maximize their returns from the compounding impact over the long term by allocating their capital to companies that routinely increase their dividend payments. The growth of dividends guarantees that the income provided by the portfolio meets or surpasses the increase in the cost of living, which helps to maintain the dividend's purchasing power. Investors can set up a powerful compounding impact inside their dividend portfolio by following these phrases in the order that they are presented. When combined, purchasing stock in companies that generate dividends, reinvesting those dividends, and concentrating on the expansion of dividends can result in large profits over the course of time. Taking advantage of this strategy enables investors to extract the maximum possible income from their holdings and lay a solid groundwork for the creation of a monster dividend portfolio. Mistakes made by dividend investors. Despite the simplicity of the 3 steps mentioned earlier, dividend investors frequently make critical errors that limit the growth of their portfolios. One of the most typical errors is to place an excessive amount of emphasis on the starting yield of a company. A great number of investors are drawn in by high initial yields under the assumption that they would start receiving a considerable amount of cash flow right away. On the other hand, businesses that have high initial yields frequently turn out to be value traps and provide returns that are very low to non-existent over the long term. It is essential to look beyond the initial yield and evaluate the entire financial health of the firm, as well as its growth prospects and the dynamics of the competitive landscape. The concentration on dividend increase as well as dividend quality is absolutely necessary in order to construct a prosperous dividend portfolio. Companies that are able to increase their dividends at a rate that is higher than the rate of inflation on a consistent basis are able to demonstrate their capacity to create excess cash flow and reward shareholders. Investors may assure that the dividend income they receive from their assets will continue to grow over time if they give priority to investments in companies like these. Investing in firms that have high starting yields but are unable to produce sustained dividend growth is the opposite strategy of this method. Investors should not be discouraged by a firm's lower starting yields if the company demonstrates excellent fundamentals, growth potential, and a commitment to increase dividends. Examples of monster dividend portfolios and the lessons learned. To build them over the years, investors have accumulated a wealth of knowledge that has helped them construct monster dividend portfolios. Investors have been able to obtain big returns by concentrating their efforts on businesses that have lower starting yields but robust development prospects. The following are some examples of monster dividend portfolios, along with some lessons learned from them. Investors have found success by putting their money into organizations that may have lower initial dividend yields but exhibit significant potential for development. Investors have been able to produce big returns over the course of time by concentrating their efforts on companies that have strong development possibilities. This method places a strong emphasis on looking beyond current dividend yields and taking into consideration the long-term growth potential of the underlying businesses in an investment portfolio. Some firms may not have high starting dividend yields, but they continually increase their payouts at a consistent and rapid pace. These businesses have been recognized by shareholders as constituting valuable additions to their dividend portfolios. Investors can boost their overall returns by taking advantage of the compounding effect of dividend income over time by investing in businesses that have a proven track record of increasing dividends on a consistent basis. This strategy emphasizes the significance of taking into account the dividend growth rate of a firm as a critical component in the process of portfolio development. The key to successfully managing a dividend portfolio is to combine the compounding effect of dividend income with the practice of reinvesting that money into opportunities that offer high returns. Reinvesting dividends back into a portfolio in order to take advantage of future growth opportunities is something that investors do rather than depending entirely on dividend payouts as a source of income. This strategy enables the snowball effect of compounding, in which the reinvested dividends generate even more income and potential profits than before. Overall, the most important takeaways from monster dividend portfolios include expanding one's attention beyond current dividend yields, concentrating on firms that have powerful growth potential, taking into consideration the track record of consistent dividend increase, and leveraging the power of compounding by reinvesting dividends. Investors might aspire to construct dividend portfolios that yield considerable returns over the long run by using these concepts and putting them into practice. Additional helpful hints are as follows. Perform adequate research. Carrying out adequate research is essential prior to investing in any stock. Beginning with the company's income statement, balance sheet, and cash flow statement, do an analysis of the company's financial statements. These documents offer insights into the company's cash flow, assets, liabilities, as well as their revenue and expenses. Look for stable and growing revenue, reasonable profit margins, sustainable debt levels, and positive cash flow as indicators of a strong business. In addition, you should study analyst papers to familiarize yourself with the thoughts and forecasts of industry experts regarding the future of the company. These reports frequently offer insightful information regarding the competitive position of the company, as well as its growth potential and dividend prospects. Maintain an awareness of the most recent company-related news and developments, as significant occurrences might have an effect on the stock price and dividend payouts. Utilize a dividend calculator. If you want to get an accurate estimate of the amount of money that will flow from your dividend portfolio, you should make use of a dividend calculator. It takes into consideration a variety of criteria, including the number of shares you own, the dividend yield of each stock, and any dividend reinvestment that may have occurred. Through the input of this data, you will be able to monitor your advancement toward the achievement of your income goals and alter your investments accordingly. On financial websites and investing platforms, you can find calculators for calculating dividends. Keep an eye on your investments. It is crucial to keep an eye on your dividend portfolio on a regular basis to ensure that it continues to correspond with your goals and the amount of risk you are willing to take. Maintain a close eye on the performance of your dividend stocks, as well as the current market conditions and any shifts that may have occurred in the firms in which you have invested. Examine your investment portfolio on a regular basis, at least once every 3 months, and take corrective action as required. The process of rebalancing entails making adjustments to the distribution of your investments so that you can keep the asset mix you want. Because of the superior performance of some of your stocks relative to others, the proportion of those stocks inside your portfolio may have grown above what you had anticipated. In order to bring the portfolio back into alignment with the desired allocation, rebalancing requires selling some of the stocks that have performed exceptionally well and purchasing more of the stocks that have performed poorly. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.